1 minute ago, something happened that most people will completely ignore. No breaking news alert, no emergency speech, but behind closed doors, a decision was finalized that could quietly redirect trillions of dollars, reshape global supply chains, and change how power itself works in the world economy. This isn't just another trade deal. This is India and the European Union together rewriting the rules of global trade. If you invest in stocks, if you care about inflation, if your job depends on manufacturing, exports, or supply chains, this affects you, even if you've never been to India or Europe. Because what just happened is not about two regions trading goods. It's about who controls the next phase of the global economy. And most people won't realize what's happening until it's too late. India and the European Union have finalized one of the largest trade frameworks ever attempted between a developing superpower and an economic bloc. We're talking about reduced tariffs, faster trade routes, easier investment access, and long-term strategic alignment. On paper, this looks technical. In reality, it's strategic. Europe needs growth. India needs markets. Together, they just created an economic bridge that bypasses traditional power centers. Europe is facing a problem it rarely talks about openly: slowing growth and rising costs. Energy is expensive, manufacturing is under pressure, and global competition is brutal. India, on the other hand, has one of the youngest workforces on Earth, rapid industrial expansion, and an urgent need to export at scale. This deal didn't happen because of friendship. It happened because both sides needed each other. When trade barriers fall, money doesn't trickle. It moves violently. European capital is now eyeing Indian manufacturing, infrastructure, technology, green energy. Meanwhile, Indian companies gain access to high-income consumers, advanced markets, stable currencies. This is how financial gravity shifts. Every major deal creates winners and losers. Countries that relied on being the middle, the default manufacturing hub, may find themselves quietly bypassed. This is not loud conflict. This is economic displacement. The United States doesn't oppose this deal, but it definitely notices it. A tighter India-EU relationship means less dependence on old trade patterns, more independent economic blocs, a world where power is more distributed. This is what a multipolar economy actually looks like. Over time, this could affect prices, job markets, stock sectors, currency flows. Not overnight, but steadily, quietly, relentlessly. What we've seen so far is just the surface, because the real impact of this deal won't show up in headlines. It will show up in markets. When a deal like this happens, markets don't react emotionally. They react logically. Not all at once, not with fireworks, but with quiet reallocations, the kind that only become obvious months later. The first money to move isn't retail money, it's institutional. These players don't chase hype, they chase structural advantage. European automakers have a problem: high costs, strict regulations, and shrinking margins. India offers scale, labor depth, and future consumers. This deal reduces friction. That means production shifts, not overnight, but inevitably. India is already one of the world's largest drug producers. Europe is one of the world's biggest buyers. Lower barriers mean faster approvals, lower costs, and wider access. For investors, this isn't explosive growth, it's stable compounding advantage. Europe wants green transition. India wants energy security. This deal aligns those incentives. Capital flows towards grid upgrades, battery supply chains, renewable infrastructure. This is long-duration money, the kind that stays invested for decades. Trade deals don't just move goods, they move currencies. Increased trade means increased currency demand. Over time, the Indian rupee sees structural support, the euro gains access to faster growth channels, not explosive currency moves, but stabilizing ones. This is how monetary gravity shifts without headlines. This isn't a meme stock moment. This isn't speculation. This is slow power. The best performing capital doesn't chase excitement, it positions early and waits. When two major economic zones integrate, others feel the pressure. Countries that relied on being cheap manufacturers, neutral intermediaries, default suppliers. This doesn't create collapse, it creates competition. Smart money doesn't ask what happened, it asks what happens next. These are the signals that confirm whether a deal becomes reality or stays political theater. Not all deals succeed. Risks remain. Bureaucratic delays, domestic political resistance, uneven benefit distribution. If execution fails, momentum stalls. Markets don't punish hope, they punish disappointment. Beyond economics, something deeper is happening, a psychological shift. Businesses start thinking differently, workers plan differently, capital allocates differently. This is how long-term economic alignment begins, quietly. Markets have noticed. Capital has started to move. The real story is geopolitical. Trade deals aren't about goods. They're about leverage. Every major economic agreement is a quiet declaration of alignment. Who trusts whom, who depends on whom, and who is trying to reduce risk. This deal signals something bigger. India and Europe are choosing strategic autonomy. China doesn't respond loudly to deals like this. It responds patiently. For decades, China was the default manufacturing partner for Europe, but rising costs, political risk, and over-concentration changed the equation. India offers diversification, not replacement. And that's the key word, diversification. China still dominates scale, but it no longer dominates options. The United States understands something crucial. You don't stop global shifts. You position yourself inside them. This is why there's no outrage, only observation. For most of modern history, global trade revolved around a single dominant center at a time. That era is ending. The future isn't one superpower, it's interconnected blocks. Flexible, redundant, strategic. In the 20th century, power was enforced by armies. In the 21st century, it's enforced by supply chains. You don't invade countries anymore. You bypass them. That's what makes deals like this so powerful and so quiet. Deals like this don't fail because of economics. They stall because of politics, protectionism, domestic pressure. Every country protects something. The question is what they're finally willing to compromise. This deal didn't happen 5 years ago for a reason. Global shocks forced governments to rethink resilience. The lesson was simple. Dependence is cheap until it isn't. India isn't chasing headlines. It's chasing manufacturing depth, export credibility, long-term capital. This deal accelerates a strategy decades in the making. Europe knows it can't compete on cost alone, so it competes on standards, technology, market access. By partnering with India early, Europe helps shape the rules, not just follow them. Expect more regional trade blocs, less reliance on any single country, slower but more stable globalization. It's easy to think deals like this only matter to governments, CEOs, or traders. But global trade doesn't stay global. It moves all the way down to everyday life. What you pay, where you work, what grows, and what disappears. Trade deals don't create jobs everywhere equally. They relocate opportunity. Expect job growth in manufacturing, logistics, engineering, compliance and regulation, supply chain management. But also expect pressure on inefficient producers, protected industries, and regions that failed to modernize. This isn't cruelty, it's competition. Over time, expanded trade tends to do one thing well. It lowers structural inflation. Cheaper inputs, more suppliers, less dependency. Not tomorrow, not next month, but slowly, persistently. The biggest mistake investors make is chasing reactions. The smart ones position for trends. These aren't explosive trades, they're compounding stories. Don't expect instant market fireworks. Don't chase rumors. Don't confuse political announcements with execution. This is a slow-moving shift, and slow shifts are where the real money hides. Here's the part no one says out loud. Trade reduces conflict. When economies are intertwined, war becomes expensive. This deal doesn't guarantee peace, but it increases the cost of chaos. This isn't an isolated event, it's part of a global pattern. Regional alliances, diversified supply chains, shared economic risk. The world isn't fragmenting, it's rebalancing. The biggest changes don't announce themselves. They unfold quietly over years while everyone's distracted by noise. By the time they're obvious, the opportunity is already priced in. The question isn't whether this deal matters, it's whether you were paying attention.